What's up, everybody? Are you ready to make 2024 your best year ever for financial growth? In this video, I'm breaking down the top 10 investments you absolutely do not want to miss. We're talking about strategies to make your money work harder so you can achieve your financial goals faster. Welcome back to another Wealth Wednesday video here at Mr. Prosperity. By the end of this video, you'll have a clear picture of where to put your money in 2024. So, grab your notebooks, let's dive in. Now, before we jump into the more complex stuff, let's start with the foundation high-yield savings accounts. While they might not make you rich overnight, high-yield savings accounts offer something invaluable, especially in uncertain economic times: security. Unlike the stock market, where your investments can fluctuate, your money in a high-yield savings account is FDIC insured. That means it's protected up to $250,000 per depositor per insured bank. So you can sleep soundly at night knowing your money is safe and sound. And the best part? These accounts are super liquid. You can access your money whenever you need it, without any penalties. Think of high-yield savings accounts as your financial safety net. They provide stability and peace of mind while your money earns a respectable return. Now, I always recommend having at least 3 to 6 months worth of living expenses in a high-yield savings account. This acts as your emergency fund, so you're never caught off guard. So, don't underestimate the power of a good high-yield savings account. Alright, so you've got your high-yield savings account set up and you're ready to level up your investment game. Let's talk about certificates of deposit, or CDs as they're commonly known. Essentially, a CD is like a time deposit. You lend your money to a bank for a fixed period and in return, they pay you a fixed interest rate. The catch? You generally can't touch your money until the CD matures. With interest rates rising, CDs offer something incredibly valuable: predictability. Unlike the stock market, where returns can be volatile, CDs offer a guaranteed rate of return. You know exactly how much interest you'll earn and when you'll receive it. This makes CDs a fantastic option for those who crave stability and want to avoid the ups and downs of the market. Think of CDs as your set-it-and-forget-it investment. You lock in your rate, and your money grows steadily over time. So, if you're looking for a safe and predictable way to grow your money, especially for your long-term goals, don't overlook CDs. Let's move beyond savings accounts and CDs and dive into bonds, specifically long-term corporate bond funds. When you buy a bond, you're lending money to a company or government. They promise to pay you back with interest. Corporate bonds are issued by companies. Long-term corporate bonds have maturities of 10 years or more. Historically, they offer higher returns than shorter-term bonds, but with higher returns comes some risk. Companies can default on their debt. A diversified bond fund can mitigate this risk, add growth potential to your portfolio without full stock market volatility. If you're comfortable with more risk, long-term corporate bond funds could be valuable. Alright, income seekers, this chapter is for you. Let's dive into the world of dividend stock funds, a fantastic way to generate passive income and boost your portfolio's growth. First things first, what are dividends? Imagine you own a small piece of a giant apple pie. As a shareholder, you're entitled to a slice of the profits. That's what dividends are, a share of a company's earnings. Dividend stock funds invest in companies known for paying dividends. This means a steady stream of passive income without picking individual stocks. Many companies reinvest profits, leading to potential long-term growth. So, you receive regular income, and your investment could grow in value. Think of dividend stock funds as the gift that keeps on giving. They provide reliable passive income which you can reinvest or use for expenses. Remember, dividend payments are not guaranteed. Dividend stock funds could be an excellent addition to your investment strategy. Alright, value investors, this chapter is right up your alley. Let's explore the exciting world of value stock funds and how they can help you uncover hidden gems in the stock market. But first, let's demystify the concept of value investing. Imagine you're at a flea market and you stumble upon a beautiful antique watch. It's a bit dusty and overlooked, but you can see its potential. You negotiate a great price, knowing it's worth far more than what you paid. That's value investing in a nutshell. Value investors seek out companies that are undervalued by the market. These companies might be overlooked or temporarily out of favor, but their underlying fundamentals are strong, and their stock prices are trading below their intrinsic value. Value stock funds take this approach and apply it to a diversified portfolio of undervalued companies. These funds employ experienced analysts who meticulously research and identify companies with strong balance sheets, solid earnings potential, and a history of paying dividends. Think of value stock funds as your treasure hunting expedition in the stock market. So if you're a savvy investor looking for undervalued opportunities and are willing to play the long game, value stock funds could be an excellent addition to your investment arsenal. Alright, growth-oriented investors, this chapter is for you. Let's explore the exciting world of small-cap stock funds and how they can potentially supercharge your portfolio's growth. First things first, what exactly are small-cap stocks? Think of them as the ambitious startups of the stock market. They represent companies with smaller market capitalizations, typically ranging from $300 million to $2 billion. Now you might be wondering, why should I care about these smaller companies? Well, here's the exciting part. Small-cap stocks have historically outperformed their larger counterparts over the long term. Think of it like this: smaller companies have more room to grow and expand their market share. They're often nimbler and more adaptable to changing market conditions than their larger, more established competitors. Small-cap stock funds invest in a diversified portfolio of these high-growth potential companies across various sectors. By spreading your investment across multiple small-cap stocks, you can potentially benefit from their growth while mitigating the risk associated with investing in any single small company. However, it's essential to remember that small-cap stocks can be more volatile than their large-cap counterparts. So if you're an investor with a higher risk tolerance and are looking for potentially outsized returns, small-cap stock funds could be an exciting addition to your investment strategy. Alright, real estate enthusiasts, this chapter is for you. Let's dive into REIT index funds and how they help you invest in real estate without landlord headaches. REIT stands for Real Estate Investment Trust. These companies own, operate, or finance income-producing real estate. REIT index funds invest in a diversified basket of these companies. REITs must distribute at least 90% of their taxable income as dividends. Own a piece of the real estate market without property management hassles. REITs have historically provided a good hedge against inflation. Diversify your portfolio and generate passive income with REIT index funds. Alright investors, let's talk about S&P 500 index funds. These funds provide instant diversification and long-term growth by tracking the S&P 500 index. The S&P 500 tracks 500 of the largest publicly traded companies in the US. These companies span various industries, from technology to consumer goods. S&P 500 index funds replicate this benchmark index. Investing in these funds means owning a piece of all 500 companies. This broad diversification mitigates the risk of single stock investments. You're investing in the backbone of the US economy. Tech enthusiasts and growth seekers, this chapter is for you. Let's dive into the world of NASDAQ 100 index funds and how they can provide exposure to some of the most innovative and fastest-growing companies in the world. First, a quick primer on the NASDAQ 100 index. Unlike the S&P 500, which includes companies from various sectors, the NASDAQ 100 focuses specifically on the technology sector. It tracks the performance of 100 of the largest non-financial companies listed on the NASDAQ stock market, a global electronic marketplace for buying and selling securities. Now, NASDAQ 100 index funds aim to mirror the performance of this tech-heavy index. When you invest in a NASDAQ 100 index fund, you're essentially gaining exposure to a basket of companies at the forefront of technological innovation. Think household names like Apple, Microsoft, Amazon, Google, and Facebook, all major players in fields like smartphones, cloud computing, e-commerce, online advertising, and social media. Investing in a NASDAQ 100 index fund is a bet on the continued growth and dominance of the technology sector. Historically, the NASDAQ 100 has delivered impressive returns, often outpacing the broader market. So if you're an investor with a higher risk tolerance and a long-term investment horizon, NASDAQ 100 index funds could be an exciting addition to your portfolio. Let's talk about a time-tested wealth-building strategy: rental housing. It offers significant long-term returns and the satisfaction of owning tangible assets. Real estate is a lot of work, but it's rewarding. From finding tenants to handling repairs, Being a landlord has responsibilities. Rental housing can be rewarding, both financially and personally. Rental income provides a steady stream of passive income. Collecting rent checks can cover mortgage payments and property expenses. Real estate tends to appreciate in value over time. Historically, real estate is a stable asset class. Owning rental property comes with tax advantages. You can deduct expenses related to your rental property. Rental housing combines cash flow, appreciation, and tax advantages. There you have it, folks. My top 10 investment recommendations to help you crush it in 2024. Remember, the key to successful investing is to create a diversified portfolio that aligns with your risk tolerance, financial goals, and time horizon. Whether you're just starting or looking to level up your investment game, I hope this video has provided you with valuable insights and actionable strategies. Don't forget to give this video a thumbs up if you found it helpful. And make sure to subscribe to the channel for more wealth-building tips and tricks. And before you go, let me know in the comments which of these 10 investments you're most excited about for 2024. Just type in 2024 to join the conversation. Until next time, stay prosperous.